Identifying undervalued stocks is one of the most powerful skills an investor can develop, because it allows you to buy strong companies for less than they're actually worth. And the moment the market corrects its mistake, you profit. So, how do you actually do it? The first and most popular method is looking at valuation ratios, because numbers don't lie and they reveal what the market often ignores. Start with the PE ratio, which compares a company's price to its earnings. If the PE is lower than its industry average, or its own historical PEE, the stock may be undervalued, especially if earnings are stable or growing. Next, examine the PB ratio, which compares price to book value. A PB below 1 often signals that the market is pricing the company at less than the value of its assets. But you still need to check the quality of those assets, because a low PB alone isn't enough. Then evaluate PEG ratio, the PE divided by earnings growth. A PEG below 1 means you're paying less for future growth, which is a classic sign of undervaluation. After valuation ratios shift to fundamental health, a truly undervalued stock has strong financials that the market is temporarily ignoring. Check the company's revenue growth, profit margins, debt levels, free cash flow, and return on equity ROE. Because companies generating consistent cash and delivering high ROE usually bounce back once market sentiment improves. Also, compare the company's performance to competitors. If its metrics are stronger but the stock price is weaker, that gap itself is an opportunity. Then move to catalysts, the events that can unlock hidden value. This includes new product launches, sector recovery, cost-cutting improvements, leadership changes, buybacks, or expansion into new markets. Catalysts matter because they often push undervalued stocks into fair value territory. Next, look at market sentiment, because sometimes stocks fall not due to bad fundamentals, but due to fear, news, overreaction, temporary issues, recession, panic, or bad quarterly guidance. These short-term emotional drops often create long-term value buys. For example, a company might miss earnings by 2%, and the market might push the stock down 20%. That is not fundamental decline, it's market psychology. Another key step is analyzing the moat, or competitive advantage. Brand strength, patents, network effects, cost advantages, switching barriers, or unique technology. Undervalued companies with strong moats eventually recover because competitors can't easily replace them. Then check insider activity. When CEOs, CFOs, and directors buy shares, it's often a strong sign the stock is undervalued, because insiders only buy for one reason: they believe the price will rise. Finally, compare intrinsic value versus market value. Use simple discounted cash flow (DCF) estimates or intrinsic value calculators. If the real value of the business is higher than its current market price, the stock is undervalued. But remember, undervalued doesn't mean cheap, and cheap doesn't mean good. Penny stocks with weak earnings, declining sales, poor management, or high debt may look undervalued, but are actually valued traps. The goal is to find strong companies temporarily trading at a discount, not weak companies permanently stuck at low prices. By combining ratios, fundamentals, sentiment, catalysts, and intrinsic value, you can consistently spot stocks the market has